In this video, we're going to take a look at the basics of financial planning and the factors that influence a company's sustainable growth rate. Our learning objectives will include developing a financial plan using a simple percentage of sales approach, examining the relationship between sales growth and the need for external financing, and then finally we'll identify and discuss some determinants of a firm's growth rate. In modeling financial growth, one of the most important and basic things to understand is the relationship between sales growth and an increase in a firm's costs. That is, it'll have higher operating expenses and it will also need to acquire additional assets. If a firm wants to double its sales, it's most likely going to have twice as much in the way of cost of goods sold, twice as high selling administrative costs. Its asset base is likely going to have to double also. It will need to have twice as much in the way of inventory, twice as much in the way of plant and equipment. It'll end up with twice as much in the way of receivables. We can relax some of those assumptions and we'll do so later on. But a basic tenet of our financial planning is that sales growth requires or is accompanied by an increase in cost. And our simplest model is going to just assume that everything changes as the same percentage as sales. That is, all of our costs will change the same percentage of sales. Our expenses will, as will our assets. Let's go ahead and take a look at a very simple model. As we move on in this chapter, some of the simplifying assumptions underlying this model will be relaxed, and we can build more complex models. But to start with, let's begin with our most basic financial statements. Our simplest financial statements will consist of an income statement and a balance sheet. On our income statement, we've got sales and costs, or we should say expenses, and then our balance sheet, we've got assets, liabilities, and equity. Let's assume we've got a year one income statement with sales of $1,000, costs of $900, with net income of $100. If we have a 10% growth rate in sales, that means our sales next year will go up to $1,100. Under our percentage of sales approach, we're going to assume our costs and assets both change as an equal percentage of sales. So if sales are up 10%, we would expect all of our costs or expenses also to increase by 10%. So they'll go up to $990, which means we'll have net income of $110. Our year two balance sheet. If we want to sell 10% more, we're going to need 10% more in the way of assets. That's inventories, plant and equipment, receivables, etc. across the board. So assets will soon increase to $1,100. We're also going to go ahead and increase our liabilities by 10% as well as our equity by 10%. So liabilities go up to $880, equity goes up to $220, and our total liabilities and equity are $1,100 and our balance sheet balances. It might be a good time to pause this video and consider for a moment what is wrong with our financial statements. Consider the link between our income statement and balance sheet. Something doesn't work here. So go ahead and pause the video and consider those two. Hopefully you remember that there's a link between our income statement and our balance sheet through our statement of retained earnings or our statement of shareholders' equity. Let's go ahead and take a look at that for year two. Recall our beginning equity is $200 and that's our year one ending balance. According to our balance sheet, our year two ending equity balance is $220. Since our net income was $110, the only way our income statement and balance sheet fit together is that if our dividends, which would be our plug in this case, would be $90. This is the only way our income statement and our balance sheet tie together through the statement of shareholders' equity. Let's consider another example, this time with a different balance sheet. Our liabilities now will be $200 and our equity will be $800. And let's go ahead with our same assumption of a 10% increase in sales. So sales grow to $1,100. Our costs will go and expenses will go up to also by 10%, which will go up to $1,045 from $950, with net income of $55. Our year two balance sheet, assets go up by 10% since sales went up by 10%. We're going to assume a 10% increase in liabilities as well as again a 10% increase in stockholders' equity, giving us our balance sheet total liabilities of an equity of $1,100. So our balance sheet once again balances. Again, taking a look at the income statement, our balance sheet, we can see the two of them don't fit together, or at least in this case, can't fit together. Let's pull up our statement of retained earnings. Our beginning equity is $800. We add to that our net income of $55. If we assume dividends are zero, even with zero dividends, this would give us an ending equity balance of $855, which isn't what we need to balance out with our balance sheet. The $855 ending equity is less than the $880 in equity we have on our balance sheet. Let's go ahead and calculate something we call our external financing needed. Our beginning liabilities at year one were $200. Our year two liabilities, for our balance sheet to balance, we need to basically plug this number, and it's going to be the difference between our total liabilities and equity of $1,100 and our ending equity of $855. And we can see for our balance sheet to balance, we're going to need an additional $45 in financing, and we refer to this as our external financing needed. What we're going to observe is if we want to grow at a faster rate than our internal financing generated by our firm, in this case we generated $55 in net income, we sort of consider that internal financing, but we needed an additional $100 in assets to support our 10% sales growth. If this is the case, our only option or alternative is to rely on what we call external financing. Let's go ahead now and take a look at the determinants of a company's internal and external, what we call sustainable growth rates, and the relationship between sales growth and the need for external financing. Let's begin by considering something we refer to as an internal growth rate. And the internal growth rate is how much a firm can grow without using any external financing. Our internal growth rate, or maximum sustainable internal growth rate, is given by the following formula. Our return on assets times B divided by 1 minus the return on assets times B, where B is our retention ratio. It's how much of our earnings the firm retains or keeps in the firm. In other words, how much does it reinvest in additional assets versus the alternative, how much does it pay out in the form of dividends. Let's consider another example. We're going to look at how much a firm can grow, assuming it takes on no additional outside financing. One thing we're going to assume is the company has a 100% retention ratio. In other words, it does not pay any dividends at all. Let's begin by calculating the firm's current return on assets. The return on assets, recall, is simply net income divided by assets. And in year one, we had $50 in net income and $1,000 in assets. So our return on assets is 5%. This means our internal sustainable growth rate is 5.26%. And again, we calculate that by taking our 5% ROA, multiplying it by the 100% retention ratio, and dividing it by the quantity 1 minus our ROA times B. So the most we can grow is 5.26% if we don't want to rely on any additional external financing. Let's go ahead and go through the numbers. So we've got a 5.26% growth rate. That means sales will grow from $1,000 in year one to roughly $1,053 in year two. Our costs or expenses will grow from $950 to roughly $1,000, and our net income will be $53. Since our sales have grown by 5.26%, we're also going to assume our assets will need to grow by that same amount. So they will go up from $1,000 to $1,053. Since our balance sheet needs to balance, total liabilities and equity will also have to be $1,053. Let's go ahead now and work on filling out our balance sheet. The first thing we're going to do is complete our statement of shareholders' equity. Our beginning equity from year one was $800. We add to that our net income of $53. And in this case, we're going to assume that we are paying no dividends. Remember, our retention ratio is 100%, so we're keeping everything and reinvesting it in assets and not returning money to shareholders, which means our ending equity will be $853. And we can pick that up on our balance sheet. Now, our plug, the number we need for liabilities to keep our balance sheet equal or balancing, then is simply the $1,053 minus the $853, or $200 in liabilities. And we can see, since we had year one liabilities of $200 Year 2 liabilities of $200. We had no need for external financing. If we were to grow at a rate faster than that 5.26%, which is what we did in the previous example, we grew at a 10% growth rate, we needed to borrow additional money. We had a need for external financing. But at a 5.26% growth rate or less, we will generate enough income or earnings internally to finance our increase in assets. If we want to grow faster than that 5.26% rate, we're going to need to rely on external financing. We're going to have to take on a little bit more in the way of debt. This brings us to another important concept called our external maximum sustainable growth rate. It's how much a firm can grow without increasing its financial leverage. The firm will take on additional debt, but it won't increase its debt-to-equity ratio or asset-to-equity ratio. It basically won't increase its financial leverage. And this rate is given by the formula ROE times B divided by the quantity 1 minus ROE times B, where again, B is our retention ratio. Let's go ahead and look at another example. So working with the same beginning balance sheet and income statement, let's go ahead and calculate the maximum growth rate where we would have no change in our financial leverage. We'll begin by calculating the return on equity. Our return on equity is 6.25%. That's the $50 in year 1 net income divided by the $800 in year 1 equity. Our maximum sustainable growth rate then is 6.67%. Again, we calculate this by taking the 6.25% ROE times 1, because our retention ratio is 100%. We're assuming we aren't going to pay any dividends. And then dividing that by 1 minus our ROE times B. So we have a 6.67% growth rate, which means our year 1 income will grow from $1,000 to $1,066.70 in year 2. Our costs will go up to $1,013, and our net income will be $53.53. Since we have a 6.67% increase in sales, we'll also assume our assets have to grow by that same percentage, so they'll grow to $1,066.70, and that'll be the same with our total liabilities and equity. Let's go ahead now and start working through our statement of shareholders' equity. Our beginning equity was $800 from year 1. We add to that our net income of $53.30. We're assuming that we have nothing in the way of dividends since our retention ratio is 100%. Again, that means we retained all of our earnings for reinvesting in new assets, which gives us ending equity of $853. We pick that up on our balance sheet, and we now have one number left, and that's our plug for liabilities. And our liabilities will be $213, and that's simply the difference between our total liabilities and equity minus our equity. Working on down through then, looking at our external financing needed, we began the year with $200. Year 2, our ending liabilities were $213.43, so we had an additional financing need of $13.40. And we can see our old debt-to-equity ratio was 25%, and that's the 200 divided by 800. Current, our new debt level divided by our new equity is $213 in debt divided by $853 in equity, and our debt-to-equity ratio remains at 25%. So the 6.67% is the maximum rate we can grow without any increase in our financial leverage. If we want to grow faster than that rate, our financial leverage will go up. If we grow slower than that rate, our financial leverage will decrease. If you look at our exact formula for our maximum external sustainable growth rate, and we know that all of these factors won't stay the same. Our profit margin won't stay the same. Our asset turnover might differ. Our leverage could go up or go down. So this is really a rather formal equation for something that will really never happen. It might be more useful to consider an approximate equation that tells us roughly how much a firm can grow. And we can get that by looking just at the numerator, which was our return on equity times our retention ratio. And using our ROE decomposition, we can see that we could break that ROE down into the three drivers: our profit margin, our asset turnover, our equity multiplier, and then finally multiplied by our B, which was our retention ratio. The first two drivers, profit margin and asset turnover, remember, have to do with our operations. How are we using our assets to generate sales, and how efficient are we at using those sales in terms of generating profits? And then the last two drivers, our equity multiplier and our retention ratio, are both financing decisions or financial drivers. So we can see our determinants of growth consist of two different types of drivers: operating and financing. If we can improve our profit margin or profitability, we can grow faster. If we can improve our asset turnover or the efficiency with which we use our assets, we can increase our growth rates. And if we can't do anything on the operating side, then we would need to change or take a look at our financial leverage and our dividend policy, financing decisions. So to increase our growth rate, to grow faster than our sustainable growth rate, we're going to need to figure out some way to improve our operations or rely on financing policies. Increase our retention ratio, which if it's already 100% we can't do, or take on more financial leverage. Let's look at one more example. Let's consider our firm again, but this time with a 25% growth rate. If our sales are growing at 25%, year two sales will be $1,250. Our costs, we're assuming, are going to go up in an equal proportion, again, 25%, so they'll be $1,125, leaving us with $125 in net income. Our assets, we'll assume, will also grow at that same 25%, meaning we're going to need $1,250 in assets. Let's go ahead now and work on our balance sheet by building out our statement of shareholders' equity. Our beginning equity, again, $800. Our year one dividends, net income, $125. If we assume we have no dividends, means our ending equity will be $925. We pick this up on our balance sheet for ending year two equity, $925, which means that our plug for debt is the difference between the $1,250 in total liabilities equity and our $925 in equity. So our ending liabilities will be $325, or we will have taken on $125 in new debt. Recall, in our last example, with a 6.67% growth rate, we only needed an additional $13.40 in debt financing. When we grew at our 5.26%, which was our maximum internal sustainable growth rate, we didn't need any new debt financing at all. But at this 25% growth rate, we need an additional $125 in debt. Debt increases from $200 to $325, which is our $125 increase. And in terms of our debt to equity ratio, we can see our old debt to equity ratio of 25% has now increased to 35%. So we were able to grow faster than our sustainable growth rate, but we needed to rely more on external financing, and our financial leverage needed to increase to keep up with that higher rate of growth. The next thing we're going to look at with respect to our pro formas is to start considering the link between our balance sheet and our income statement. With this higher level of growth, we needed to take on additional financing. And when our debt goes up, our cost will also go up. In particular, our interest expense will increase. Consider for a moment our income statement. As we increase the level of debt from, say, 325 to 326, our costs will go up as our interest expense will increase as we borrow more money. This causes our net income to go down, which decreases our ending equity balance, and likewise then means we will need to borrow more money. If, on the other hand, we had lower levels of debt, we would have lower interest expense, lower costs, which means we would have higher net income, higher ending equity, and we would need to borrow proportionally less money, and our debt would go down. So there's a circular link between the amount of debt we have and our cost on our income statement, which is our interest expense, and our ending equity, and then again our balance sheet. We'll explore this link further in the next segment on pro formas.